we're a country addicted to spending, adding $1 trillion in debt every 100 days. Inflation is the symptom, not the driver. That's the bottom line. And our spending habits aren't going to change anytime soon. And so deficits will get bigger, interest rates will rise further. And, the term in economics, Gibson's paradox, which traditionally speaks to the inverse relationship between real interest rates and the price of gold in particular, in this case, seems to not be as relevant in an environment where gold and silver prices are not aligned with their usual drivers, in particular the 10-year Treasury yield and strong dollar, because as Vince will often say, they just want the metal. And I think India just wants the silver. China just wants the gold. Of course, I'm generalizing there. I think China is a big buyer in silver as well. But, you can, and let's say there's empirical evidence to that showing that in silver this morning in Shanghai, the market opened up, limit up, and opened up at $35.38 an ounce. But on the Shanghai Futures Exchange, it opened up 8% limit up on Monday morning. And so when you talk about the drivers that typically would spell a reversal in the price of gold, a strong dollar, strong interest rates, in this case, and an inflationary agenda that seems to be running out of control, which would speak to higher rates for longer, it doesn't matter. I think that's really what's different this time, is that the pursuit of non-dollar denominated liquidity is outpacing the demand for dollars in U.S. Treasuries.
Andy Schectman highlights a critical shift in the global financial landscape. The U.S. is adding $1 trillion in debt every 100 days, fueling inflation and raising interest rates. Despite a strong dollar and rising Treasury yields, silver prices in Shanghai surged to $35.38 an ounce, showing a massive 8% limit up. This unprecedented demand from countries like China and India indicates a major de-dollarization trend. Schectman predicts a continued surge in silver prices as global trust in the US dollar wanes, potentially leading to hyperinflation and stagflation.
That's what happens, the little by little, the logarithmic decay, the chipping away at the hegemony of the dollar, all of these countries that are not Western friendly in the Southern Hemisphere, chipping away at the settlement status of the dollar, trading in local currencies, replacing those local currencies with gold and oil in terms of excess reserves that normally would wind up in treasuries. That little by little by little by little, the debasement of the settlement and the reserve status of the dollar is growing much more profoundly. And I think this is a situation where when you talk about rising prices, look, if you spend $100 every second of every day, 24/7, it would take 1,970 years to print just as many dollars as we've spent in 1 year, over $6 trillion or created in 1 year. The level of inflation that was created by money creation, the classic definition of it, is exactly what we should be expecting. And that hasn't even flushed its way through the system yet. The debasement or the falling dollar is a reflection of the weaponizing of the dollar, is a reflection of the fact that these countries no longer trust us. It's like a glass broken into a million pieces. When you break it, you can't put it back together, at least not very easily. And so what you are seeing is a byproduct of the same time of the ramifications of massive money creation, most of it done over the years where interest rates were near zero, creating huge distortions in asset prices. The end of it is rates were still rising. Well, they were still creating tons and tons and tons of money, which is going to fuel the inflation. And as rates rise, maybe that we head towards that stagflation. But the point of it is that I think there's a disconnection now, whereas in years past, everyone wanted dollars, everyone wanted treasuries, everyone wanted to be part of the American system. And that system no longer, I think, is inspiring as many participants as it once were. So yes, I see this exact same way that Rafi does, maybe hyper stagflation, higher prices, higher taxes. What did the knucklehead say? If he wins again, he wants to raise capital gains to 44.5%. He wants to raise income taxes. He wants to impose a mandatory tax on unrealized gains for the very wealthy, higher taxes, higher inflation, little or no economic growth. And I do see a time where the world finally, that all at once moment triggers, and there is a dumping of dollars, there is a dumping of treasuries that accelerates not just what we've seen slowly and methodically and orderly, where China has gone down to 750 billion from over 2 trillion, almost 3 trillion. That's the little by little by little. The all at once hasn't happened yet. But what I do think, when the all at once happens, it will shock people. Like to Rafi's point, no one knows that silver is over 30 unless you're in our camp. And it's a very big deal for the people in our camp. Most people wouldn't know a silver dollar if it fell on their foot, or the ramifications of rising silver, what it really means, or massively rising gold and de-dollarization. All of this stuff we focus on, the public is asleep. And so I see the exact same thing: higher prices, higher yields for longer, and continued de-dollarization and de-treasurization that we continue to foster. Where Janet Yellen has the nerve to tell China, if you give 1 penny to Russia to aid their war machine, we're gonna sanction your banks, your companies in Beijing itself. Don't worry that we've given 200 billion to the Ukraine with no congressional oversight. That's our business, and we're the world reserve currency. This is not settling well with the Southern Hemisphere. So yeah, I think that's exactly what will happen. Now, to your point, what does it look like? Who knows? I mean, yeah, I think it won't last forever, but there could very well be a time where things of value are used to barter, because who's going to want dollars in an environment where no one wants to hold them for any significant amount of time whatsoever? So yeah, I don't know how it all works out. I don't know if the companies like mine become the banks, because quite frankly, what I really see happening is that, Rick Rule keeps saying it, and he said it again the other day. From the Harvard Endowment Fund all the way down to Joe and Jane six-pack, you have a 0.5% allocation. If, pardon my French, the shit hits the fan that bad, which awakens the collective, realization, the collective consciousness that the realization this is real. And if you are not a contrarian, you're destined to be a victim. If that just increases to 5%, that's a tenfold increase. So the ability of a company like mine or this industry to be the bank quickly ends in an environment where, just like anything else in this country, inventory is just in time. And when you run out of available inventory, well, you got to order from the mints, of which 3 of the 5 major mints around, or 4 of the 6 major mints around the world are across the Atlantic Ocean. And so it's not an easy deal to where, you get an awakening by the public real quick. I think everyone's out of product, and it doesn't foster any liquidity moving back and forth. And that's why they say there's no bull market like a metals bull market, because it's the only one where the higher the price goes and the freakier the world gets only solidifies your resolve and your grip on I'm not selling that back for dollars. Are you out of your mind? So yeah, I think it probably wouldn't be a situation where we are the bank, but it would be for a day or two until the public drains everything that's available, and then we're back to square one again.
Continuing the discussion, Andy Schectman exposes a recent report by Canadian Securities suggests China is massively understating its metal holdings. Meanwhile, stockpiles on the LBMA are at their second lowest in 140 years, and both New York COMEX and Shanghai exchanges are bleeding metal. Schectman highlights that China's strategic move to raise silver prices by nearly $4 in Shanghai aims to attract Western metal through arbitrage. As China cunningly outmaneuvers the market, it's clear they are steps ahead, accumulating as much silver as possible.
There was a report that came out recently, and it came out by TD Securities in Canada, that said that the Chinese are massively understating the volume or the amount of metal that they actually own. And when you realize that the LBMA, there was a report that in April that the stockpiles held by the LBMA in silver are the second lowest they've ever had on record. It's a 140-year-old exchange. And at the same time, we've talked at length about how both the New York COMEX and the Shanghai are starting to bleed metal precipitously. TD Bank, when talking about the LBMA, said that they're massively overstating as well, not only the positions that they own, but the available volume of metal in the LBMA, because it includes the exchange traded funds that are not broken out. And you got Bullion Vault, and you got SLV in there, and other things that's encumbered. And so they're down to their lowest level ever, which means that you have the industrial users are relying on going directly disintermediating the miners, and they typically rely on the miners for supply, and so they have to seek outlets. I think by draining the inventories, you're seeing that the inventories are being completely and totally drained, and I think China maybe realizes that, so they're trying to turn up the arbitrage spigot by putting silver almost $4 higher, so that the traders who do have the ability to purchase in the West are able to do so and deliver in Shanghai, those that have that ability. And there's been a lot of talk lately about the exchange for physical, in terms of all of the exchange for physicals being sent to Brinks, Hong Kong, which is a COMEX facility. Huge amounts of gold kilobars in particular, large amounts of kilobars that are leaving the Western vaults. It's the mini contract on COMEX and is being delivered in exchange for physical off in the OTC market, really. And then the theory is they're being trucked directly from Hong Kong to the Shanghai Gold Exchange. So they are trying any way that they can to accumulate whatever they can, whether it be by exchange for physical, whether it be by taking whatever they can out of the LBMA, whether it be taking whatever they can out of the COMEX, whether it be backdooring the ETFs. And I think now what they're trying to do is arbitrage. That $2 premium became $3 and now is almost $4. They're turning up the heat to attract as much arbitrage as possible. I think they think very shrewdly, cunningly. They are 2-3 steps ahead of the game. And to me, that's what that really symbolizes. When you see Shanghai Metals Exchange, which in terms of volume, when you add the Shanghai Metals Exchange and the Shanghai Futures Exchange, the average daily volume is greater than the COMEX now. It is effectively the #2 largest center in the world for trading metals, behind the LBMA.
Thanks for watching. Here's a quick recap. Andy Schectman discussed the rising national debt and how inflation is a symptom of excessive spending. He noted unusual market dynamics where traditional drivers of gold and silver prices aren't having their usual effects. Schectman emphasized China's strategic accumulation of metals and the potential for significant shifts in the global metals market. He also mentioned the possibility of hyperstagflation, higher taxes, and a move away from dollar-denominated assets.